Hello and welcome to Stock Market Foundations, the beginner's course to start investing the right way. My name is Jason Whaling, investor and founder of the Wealth Titans, and I have the honor of taking you through this entire course and answering all your questions along the way. Oh, and before we get started, please note that all the information presented here is for educational purposes only and should not be construed as financial advice. Okay, so please don't sue me for trying to help you learn how to invest. It's pretty much what that comes down to. All right. Now, I recognize that not everyone starts in the same place. And so keeping this in mind, the course is designed to be an interactive and dynamic learning process. Each module covers a specific topic in depth. You can kind of jump in straight to which module you think is going to help you the most. In Module 1, if you're completely new, this is the place to start. We'll cover the basics of what the stock market is and what the stock market characteristics are of each kind of component in the markets. We'll also touch on some of the intermediate insights on how to actually use the knowledge of how the stock market works to your advantage so you can start mastering some of the more advanced investment concepts and descriptions. So that's what Module 1 is all about. Module 2 dives into the movements of the markets. We will briefly cover what Module 1 starts to cover, but then take it to a whole nother level because it's such a big subject. We'll spend time exploring the entire inner workings of the market so you can get a comprehensive understanding of what moves the markets and why. This is really important because most investors act like traders even without knowing it, which results in buying and selling at exactly the wrong times. And we've all had a horrible experience of purchasing a stock or only to have it immediately drop a day or two later, sometimes minutes later. And I guarantee this won't happen to you again after watching this, but I can say that you'll be much more informed and be able to be much more tactical with your investing after viewing this module. In Module 3, we discuss the different types of traders and investors, and more importantly, the difference between trading and investing. If you're not sure what you want to be, a trader or an investor, this module will clearly outline your options and the pros and cons. There are hundreds of ways to make money in the markets, and we'll discuss some of the more common so you can help identify the best combination of what will work for you. Finally, in Module 4, brings us home by providing a basic outline of the different analysis techniques we can utilize to be successful when in trading and investing. Then it concludes with the best next steps so you can quickly put the information that you've gathered from this course to work for you in the markets. I've also included some bonus stuff that has been linked to so you can really get your investing off to a great start. As always, I want to hear from you, so make sure you're getting the most out of this course by leaving comments in the comments section below. I do read it and I do answer the questions. So, without further ado, let's get started. All right, Module 1, Stock Market Basics, Introduction to Market Foundations. If you plan to invest in the stock market and make money, we need to accept that it's not always going to be an easy job. Too many people treat the stock market as if it were a savings account, as if you can just kind of put money in each month and expect it to miraculously grow. The reality is that investing in the stock market successfully requires an education and some work on your part. Just as you wouldn't want a nurse to have gone through a couple of hours of training before taking care of you and doing a blood transfusion, you want some basic education before you put your hard-earned money into the markets as well. It's pretty much the same concept. Increasing your level of financial education is important now more than ever as the markets are becoming increasingly more competitive and complex. When you put your money into the markets, you are in a competition. You're competing with other investors and traders. You're competing with the hedge funds, investment banking professionals, and hundreds of supercomputers trading at light speeds. So before placing a single penny in the markets, we at least need to have a basic understanding of where your money is actually going in the harsh realities of the market environment. Also, did you know that most orders you place actually don't even get to the live markets if you're using a discount broker? It's something called dark pools. Really fun and advanced. So if you're one of those people who likes reading the footnotes and digging into things, look up dark pools. It'll blow your mind. Anyway, this course is designed to pretty much do just that. Dive into the nooks and crannies of the market and give you a basic overview with a little bit of advanced overlay so you get a really good foundation. So in this module, we're going to look at how the stock markets function, basic stock market definitions, the various types of stocks available, dividends, why companies issue stock in the first place, and wrap up with some more common terminology. All right, so what are stock markets exactly? Stock markets are also sometimes called equity markets or capital markets, and they're centers of where shares are publicly traded shares are traded, and these are by public companies. So they're called public companies because their shares trade publicly. It's pretty much as complicated as that part of the process gets. And there are times where you'll hear the stock markets referenced as equity market or stocks called equities. And this term is simply an accounting term just referring to stocks themselves, since stocks on a company's balance sheet are listed in the equity section. And we can get into financial statements in a bit later, but for now just know that when you hear the term equities or equities markets or capital markets, generally we're talking about the stock market. And the stock markets are normally divided into two types. We have primary markets and secondary markets. Primary markets are when companies issue its stocks or shares for the first time. The secondary markets is where investors and shareholders are buying or selling stocks among themselves. So the company is not necessarily involved in the transaction. And that's where a majority of the investing and trading occurs, in this secondary market. So here's how these exchanges that for the secondary market operate. And a stock market is represented normally by a physical entity known as a stock exchange. Stock exchanges are networks that connect investors to each other. They act as a platform upon which traders and investors can buy and sell from each other. And this is, again, the secondary market. Many countries have their own exchanges, but larger countries like the US can have several. In movies and televisions, you'll see them as open floors with brokers shouting and buying and selling and shouting prices across each other for either themselves or their clients. This is mostly for show, since almost everything's done electronically now. Even the New York Stock Exchange building itself, the actual exchange is over in New Jersey. I mean, the exchange floor now is pretty much just for filming and fluff. There's no way better to put it. So the most well-known exchange in the United States is the New York Stock Exchange. And then we also have the NASDAQ. And as I mentioned earlier, both of these are less and less physical locations as opposed to just giant data warehouse supercomputers doing all of the transactions where people used to be running around floors yelling at each other. So let's look at what a stock actually is. A stock or share is the smallest unit of ownership that a company distributes. When you purchase a stock in a company, you are effectively becoming a part owner of that company. As an owner, you have the same rights as all the major and minor shareholders of the company, which includes attending shareholder meetings, voting boards of directors in and out, and voting on major company decisions, such as mergers or acquisitions. Mostly just mergers nowadays. Why do we own stock? We own stock to be a part owner of a corporation. But unless you're doing hundreds of millions of dollars, your stake in the company probably isn't going to get you that far. So when a company earns more money than it needs to continue normal business operations, it can do one of two things. And this is where being a company owner comes in handy. They can either reinvest it back into the company to make it grow, or they can distribute the extra earnings to shareholders in the form of a dividend. It's important to note that dividends aren't necessarily in cash, but we'll cover that in the dividends section. As a shareholder, you benefit from both decisions ultimately. If the company decides to reinvest its extra earnings, you benefit in the long run from resulting growth and increase in share price. In the case of a dividend, depending on the type, you wind up with cash, with a cash flowing asset, more cash in your pocket that you can reinvest as you see fit. So you can take the dividend and reinvest it in the company, or you can take the dividend and reinvest it in another company. So even though you are a part owner and you have voting rights, because your interest in these giant, mega billion-dollar companies are so small, we tend to focus on what their growth is and if you're going to get a dividend from them, not, hey, how many shares can I buy so I can start influencing the company? And so now that you're part owner in the company, you can consider reinvesting those dividends in the company or taking them elsewhere. So here's the stock advantage. One of the major advantages of owning stocks when compared to other assets is that they are paper and offer limited liability. So let me explain these two. As a paper asset, all of your ownership is kept electronically with your broker. When you invest in hard assets such as real estate, land, metals, or private businesses, you have physical goods that you have to keep track of and take care of. Another advantage is the liquidity of stocks. As it could take a couple days or weeks or sometimes even months to sell a house, you can buy or sell a stock in seconds because there's such an active market. And so that's the advantage of a paper asset. It's all electronic. You don't have to store it anywhere. You don't have to go look and make sure that your rental property isn't falling apart, and you can pretty much sell it on a dime, unless you're investing in ridiculous penny stocks where it'll take a week or you're going to have to take a dollar loss on your thing to sell it. But anyway, don't do penny stocks unless you know what you're doing. Most people don't, so stay away. Anyway, all right. Next, we have limited liability. Another major advantage of investing in stocks when compared to other options, particularly real estate or investing in private businesses, is the presence of limited liability. If the company loses any lawsuits or other disputes and is ordered to pay hefty fines, which if you've read the news lately about any bank, they pay a lot in fines, the maximum loss to you is the shares you are holding become worthless. They can't come after you personally for your assets. The creditors would not be able to take your private assets because of the protection. You're just a stockholder. You're not actually in the business. They can't sue you. And this is applicable even if the company declares bankruptcy. So if any funds remain after creditors have been paid, well, you might receive a proportionate amount of whatever's left over based on how many shares you have. This almost never happens, though. When a bankruptcy goes through or creditors come knocking, normally the whole thing just collapses and falls apart, and there's no money left over for shareholders. All right, so let's get to the stock disadvantage. Now, our discussion wouldn't be complete if we didn't talk about some things that just kind of don't work for stocks. And one of the disadvantages is it's a paper asset. It's an advantage and a disadvantage. As a paper asset, stocks are very sensitive to government policies such as interest rates and currency inflation rates. And this means that from a strictly economic standpoint, short-term stock returns can sometimes be highly correlated to government monetary policy or people's perception of how the economy is doing. So you get a lot more price fluctuation with stocks than you do with other markets such as physical precious metals or real estate. And then we have the big one, which is manipulation. In terms of foul play and unfair business practices, the stock market is pretty much at the top of the list. Prices are constantly manipulated, especially with lower price stocks, to suit the interest of hedge funds, large banks, and sometimes even companies themselves. However, as you become more educated, you will actually be able to use this to your advantage and save yourself a great deal of pain. But when you are uneducated, your hard-earned money is pretty much up for grabs, as 2008 painfully demonstrated. Now let's talk about the different types of stocks. The most common types of stocks are common stocks and preferred stocks. Preferred stocks have lesser rights compared to common stocks, but when it comes to dividend payments, most preferred stocks will have priority in receiving them, even if common stocks do not receive a dividend. So dividend-focused investors will sometimes find these more attractive because of a guarantee of dividend payments, and these payments are often higher than they would be for common stocks. As beginners, we want to steer clear of these stocks because they are much more complex in nature, and each company handles them differently, and they aren't as liquid or even behave in the same manner as common stocks. So most of us will be investing in common stocks, the majority of stocks that individuals like ourselves buy and sell in the market. Common stocks have voting rights in shareholders' meetings, and they also have the right to receive dividends, but only after preferred shareholders have been paid. And again, this is on a company-by-company basis. Every company does it a little differently, which makes preferred stocks complicated. Both of them do have liquidity, though. And a major advantage of common stocks is they have much higher liquidity than most preferred stocks. This means that there is an active market for the asset. If you're holding stocks of companies that trade frequently, you can easily find opportunities to sell at reasonable, profitable prices. However, if we held shares of more obscure companies, smaller companies, one with less trading volume per day, namely in this example, some preferred stocks, you might find that your ability to trade or liquidate them when you want to sell them is greatly inhibited because there's not enough volume. There's just not enough people looking at those types of stocks because everyone's trading with larger companies, or they're looking at common stocks instead of preferred stocks. So it's always advisable to hold stocks of companies that trade nearly every day in considerable volumes. Otherwise, we can find ourselves stuck with a stock that nobody else wants to buy. Next, we're going to talk about shareholder income, cash dividends, buybacks, bonus shares, and stock splits. So this is all the things companies can do to and with the stock to essentially provide value to their shareholders. So this is how the company can help make you a better return on your investment. And dividend payments that occur when companies have excess profits. The most common form of dividends is a cash payment, and these are simply called cash dividends because the company simply just divides the cash among shareholders and gives it to them. Then we have companies. Sometimes companies offer their shareholders excess profits from multiple years, and this can sometimes happen with preferred stocks where they might not pay a dividend for a year or two, and then all of a sudden they'll pay a big dividend. So that's sometimes what can happen with cash dividends as well. If a company decides to hold on to profits and reinvest them in the business for expansion, development, or growth, it's called retained earnings. And that's retaining the earnings. They're keeping the earnings instead of distributing them as dividends. Normally, large, well-known companies announce dividends along with their quarterly results, while many others issue dividends on a semi-annual or annual basis. And most dividends payments are in cash, just paid directly to you. Also, some companies allow you to take that cash dividend and automatically buy more shares. That's a little more advanced and changes with the broker that you use. The amount a shareholder receives with a dividend will depend on how many shares they own divided by what's announced by the company. And this is simply saying you have a proportionate share. Your proportionate share of whatever earnings are distributed is based on how much stock you own. So if you owned 10%, you would get 10% of whatever the total dividend pile was. Oh, and like I said earlier, jumped ahead of myself, many companies do offer dividend reinvestment plans, where instead of receiving cash, investors can opt to automatically buy more stock with their dividend payments. This can prove to be more profitable if you do not need immediate cash, because it can allow you to build your investment portfolio much more quickly. Next, we have buybacks. Well, cash dividends are the most common form. Companies can also engage in buybacks, where they buy back stock on the open market to decrease the supply of their stock. This helps stockholders because the decrease in supply tends to increase the price of the stock. Less stock available, the higher the price becomes, generally. Next, we have bonus shares, and this is another non-cash dividend practice corporations engage in offering a way to a way for profit for shareholders. And these shares are offered to current shareholders on the basis of the number of shares that they already hold. So even though bonus shares do boost the total number of shares that the company has issued, the value of the company will not normally change by the issue. Another important point to understand is, in spite of the increase of the total number of shares outstanding, the ratio of shareholders will not change. They're simply giving more shares to current shareholders. Normally, only certain classes of shares are entitled to receive bonus shares issues, so this is where preferred stock versus common stock comes into play, and a higher preference to receive different classes of stock. Finally, we have stock splits. A stock split also increases in the number of shares issued by the company. However, the price of the stock split is adjusted in such a manner that the market capitalization value, the total value of all stocks outstanding, does not change, and there's no dilution in people's ownership. So here's what all that mumbo jumbo means. Stock splits can be in different ratios, such as 2 shares for 1, or 3 shares for 1, or 3 shares for 2. But we'll stick for 2 to 1 because that's the most common. Companies usually resort to stock splits when the price of a stock has risen substantially, so they use the split to bring it back down. So here's the example. If a share is quoted at $50 in the market, and if the company announces a 2-for-1 split, the value of each share will get adjusted to $25 because the number of shares outstanding has doubled. So let's say there's 500 shares in the market and they're all trading at $50 a share. When they announce a 2-for-1 split, what they're doing is they're splitting each stock into 2. So instead of 500 outstanding, now we're going to have 1,000 outstanding. But the total value of those stocks doesn't change. They're just cutting it in half. So instead of being 500 shares at $50, it's 1,000 shares at $25. So you can see they're just doubling the number of shares, but they're not messing with what the stock is actually worth. All right, now we're going to get into reasons companies issue stocks. The first time a company issues a stock in the general market, it's called an initial public offering, or IPO for short. And you'll hear IPO a lot. Companies do this primarily to raise money for the business. And here's some more common reasons companies issue stock. Raising additional capital for a recent business expansion or a new development, for developing new products, building new factories, purchasing the latest machinery, hiring more employees as part of a business expansion, for acquiring or merging with other companies, reducing existing debts, so issuing more stock to pay their debtors, to enhance the value of the company, and finally to provide greater flexibility to current company owners and managers. Getting the information you need. With more than 8,000 companies listed across the American exchanges, ticker symbols are used to easily identify companies and investment products. A ticker symbol can be anywhere from 2 to 4, sometimes 5 characters to identify a stock, index, or fund. Every stock has a unique ticker symbol that acts as an identifier of that company's stock. Some characters or lengths in tickers have significance based upon the type of stock or fund it represents. For example, if a stock has 4 characters, it means it's listed on the NASDAQ, while ones with 3 are listed on the New York Stock Exchange. The best place to find free financial information is Yahoo Finance. In most instances, these free sites, like Yahoo Finance, which is still my top one for over a decade, will provide you with more than enough information to make an educated investment decision. If you're looking to be a trader, you will have to pay for real-time information or choose a broker that provides you free real-time information if you make a certain number of trades per month or per quarter. But for investors, receiving delayed market data really isn't an issue, which is why I pretty much stick with Yahoo Finance and I don't worry about trying to pay for live quotes. All right, so we're coming to the end of Module 1, and I wanted to wrap up with some additional learning resources for you. because it's very difficult to present all the terminologies and their meanings related to the stock market here, since there are over 8,000 terms and definitions. That being said, I've done my best to present the most important parts, and hopefully this module has answered some if not most of your basic questions. If you have any questions or suggestions for future videos or future content updates, please leave a comment in the comment section. I do read it. As you continue to learn and increase your financial education, I've included some helpful links below in the description. Investopedia is a great resource for investing and trading definitions. I still use it to this day. So if you ever need to look up what a word means, should be your go-to source. Also, shameless plug, thewealthtitans.com has a great selection of free training modules and blog posts. And be sure to subscribe to my YouTube channel here for weekly insights so you can continue to improve your investing results. So thank you again for watching. I hope you found this informative and actionable. This concludes Module 1 of the Stock Market Foundations course. If you have any questions or comments, please just drop your thoughts in the comments section below. And don't forget to check out my YouTube channel and subscribe so you can stay up to date with the latest investment insights. And I'll see you in the next module to your investment success.